Hello everyone, my name is CA Neeraj B. Welcome to my YouTube channel @Accounting Buddy NB. Today we are starting a new chapter in our accounting learning series, Bank Reconciliation Statement, commonly known as BRS. In part 1 of this chapter, we will focus on 5 key areas. First, we will understand the meaning, purpose and importance of preparing the BRS. Second, we will look at the difference between the bank holder's books and his bank passbook. Then we will go through the steps to prepare BRS and also discuss the main features of a bank statement. We will also identify the common causes of differences between the cash book and passbook, including the timing issues and errors or omissions. And finally, we will see practical examples such as checks issued or deposited, bank charges, interest, direct deposits and payments. So let's begin part 1 of our journey into understanding bank reconciliation statement. Let us understand the meaning of the term bank reconciliation statement. Bank reconciliation statement is a document prepared by the bank account holder on a particular date, which can be any date of the accounting year, to compare and reconcile its own bank balance as per bank column of the cash book with the balance as per bank statement or bank passbook to find out the reasons for difference between the two balances. The bank account holder records all the deposits in the bank column on the left hand debit side or the receipt side, and all the bank withdrawals on the right hand credit side or the payment side of the cash book. Bank also maintains an account of the account holder in its books of accounts. Deposits made by the account holder are recorded on the credit side of the account holder's account, and the withdrawals are recorded on the debit side. Bank account holder maintains his books of accounts and bank maintains their books of accounts to record their respective transactions between them. Bank account holder maintains a ledger account of the bank account in his books of accounts. Similarly, bank maintains account holder's account in his books of accounts. Now, when cash or check is deposited by the account holder in the bank account is debited in the books of accounts of the account holder, and in the books of accounts of the bank, account holder's account is credited with the amount deposited. Now, when account holder makes any withdrawals from his bank account, the bank account in the books of accounts of the account holder is credited, while in the books of accounts of the bank, such an amount is debited to the account holder's account. Now, any other transaction which increases the bank balance will be debited to the bank account in the books of accounts of the account holder, while all such amounts will be credited to the account holder's account maintained in the books of the bank. Any other transaction which decreases the bank balance will be credited in the bank account maintained in the books of accounts of the account holder, while all such amounts will be debited to the account holder's account maintained in the books of accounts of the bank. Let us now understand the purpose of bank reconciliation statement. The main purpose of bank reconciliation statement is to identify and explain discrepancies between the cash book and the bank statement. Bank reconciliation statement is also ensures that all the bank related transactions have been recorded correctly. Bank reconciliation statement also ensures to detect errors, omissions, or fraudulent activities. Bank reconciliation statement also provides an accurate view of the cash position. The common causes of difference between the cash book and the bank statement or the bank passbook are: number one is check issued but not yet presented for payment. Number two cause is checks deposited but not yet credited by the bank. Bank charges, interest or direct debits recorded by the bank but not yet entered in the cash book are some of the causes of difference. Further, errors either in the cash book or the bank statement also causes the difference between the two statements. Let us learn the steps to be followed to prepare a bank reconciliation statement. First and the most important step is to compare the entries in the cash book with the entries in the bank statement. Once the entries which are recorded in the cash book but not appearing in the bank statement, or the entries appearing in the bank statement but not recorded in the cash book are identified, then we adjust the cash book balance or the bank statement balance accordingly. Once the unmatched transactions are identified, record the reasons for differences, post which the bank reconciliation statement is prepared to show those adjustments. Start the bank reconciliation process by comparing the two statements, that is the cash book and the bank statement. Basis one-on-one comparison of transactions in both statements, identify the differences in terms of transactions which are appearing only in one of these statements. Such common differences are checks issued but not presented. This means a check is issued by the business and is recorded in the cash book, but it is not presented to the bank for payment. Therefore, it is not debited in the bank statement. Checks deposited into the bank but not credited by the bank is another common reason for difference between the cash book balance and the bank statement balance. Other reasons are bank charges and the bank interest charged by the bank, direct deposits and withdrawals, errors in cash book and bank statement. All these reasons of difference will be discussed in detail in subsequent slides. Once all the reasons of differences are identified, all such transactions are adjusted and bank reconciliation statement is prepared. We start either with the balance as per cash book or the balance as per statement and keep on adjusting the transactions identified to match or complete the bank reconciliation process. Let us understand the term bank statement or bank passbook. A bank statement or a bank passbook is a record given by the bank that shows all the transactions related to the deposits and withdrawal made in your bank account over a period of time. In other words, it is a copy of account of the account holder in the books of accounts of the bank. It helps to know how much money account holder have on a particular date, where account holders money went, what money account holder received. Debit balance in the bank statement means the account holder has overdrawn the amount and the amount is payable by the account holder to the bank. Whereas the credit balance in the bank statement means the amount of the account holder lying in the bank. Main features of the bank statement or the bank passbook are: it shows customer details, that is the name of the customer, its account number and the name of the bank branch in which the account is maintained. It also shows the opening balance of the account holders at the beginning of the period. Bank statement shows the complete list of all the deposits and withdrawals from the bank account with date and each transaction details. Bank statement also shows if the bank has charged any fee or has given any interest. It records all the transactions in a chronological order, that is, all the entries are shown in the order they happened. It also shows the final amount left in the account holder's account after considering all the transactions for the period. Bank statement is regularly updated and given by the bank on monthly basis or on request. Bank statement document helps in tracking account holders' money, check the mistakes and match with account holders' records like the business cash book. Let us now learn the importance of bank reconciliation statement. Bank reconciliation is vital for several reasons, contributing significantly to financial accuracy, control, and decision making. Bank reconciliation ensures accuracy of financial records. It helps identify and correct errors made by either the business or the bank, ensuring that the cash balance in the company's book accurately reflects the true cash position. This is fundamental for reliable financial reporting. Bank reconciliation detects and prevents frauds. Regular bank reconciliation statement helps spot suspicious or unauthorized transactions such as forged checks, unauthorized withdrawals, or missing deposits, allowing businesses to take prompt action and minimize losses. It acts as an internal control mechanism. Bank reconciliation statement also helps to improve cash flow management. By providing a clear and up-to-date picture of available cash, businesses can make informed decisions about spending, investments, and managing liquidity. It helps avoid overdrafts and unnecessary bank fee. Let us learn the importance of bank reconciliation statement. Bank reconciliation statement facilitates audit and compliance. A reconciled bank statement provides a clear audit trail of financial transactions, making the audit process smoother and ensuring compliance with accounting standards and regulatory requirements. It demonstrates financial transparency. Bank reconciliation identifies timing differences. It helps distinguish between the actual errors and temporary difference due to the timing of the transactions, preventing unnecessary panic or incorrect adjustments. Bank reconciliation statement identifies transactions that the bank has recorded but the company has not yet, such as bank charges or direct deposits, allowing the company to update its cash book accordingly. Bank reconciliation statement also supports business and enhances decision making. With accurate cash balance, businesses can make better strategic decisions regarding the financial planning, budgeting, and forecasting. Let us now understand why bank reconciliation statement is required. A bank reconciliation statement is crucial accounting document that comprises a company's or an individual's cash records, which is usually the cash book or a journal ledger, with the bank account statements for the same account for a specific period. The goal is to identify and explain any differences between the two balances and ensure that both records are accurate. Let us now quickly understand the reasons of difference between the balance as per cash book and the bank statement. The need for a bank reconciliation statement arises because the cash balance in a company's book almost never matches the balance shown on the bank statement at any given point of time. The reason for difference can broadly be classified into three categories: timing differences in recording entries, transactions recorded by the bank but not recorded by the account holder, errors either in cash book or the bank statement. We'll discuss about all these reasons in our subsequent slides in detail. Let us now understand in detail how timing difference is one of the major reasons of difference between the balance of the cash book and the bank statement. There is always a timing gap between the recording of a transaction in the cash book and it being recorded in the bank. Timing differences occur when either the company or the bank records transactions at different times. This leads to a temporary mismatch between the cash balance in the company's books and the bank's records. For example, a check issued is recorded in the cash book as soon as it is issued, but the bank records it when it is presented for payment. A check deposited is recorded in the cash book when it is deposited in the bank, while the bank credits it when it is cleared. Let us further strengthen our understanding of the reasons of difference due to recording of transactions at different time. Checks issued but not presented for payment refers to a check that a company or an individual has written and recorded as a payment in its own records like cash book or general ledger, but the recipient or the payee has not yet deposited or encashed that check at their bank. As a result, the money for that check has not yet been deducted from the company's bank account by the bank. This creates a timing difference because companies' books show the money has been paid out and the cash balance has decreased, whereas the bank statement does not yet show the deduction, so the bank balance appears higher than what the company's books reflect for actual available funds. These checks are often called outstanding checks. Let us now understand the reasons for difference in detail. In this slide, we will explain the most common reason of difference, that is the checks issued but not presented for payment, with example. Let us say ABC company had a cash balance of $10,000 in its accounting records, that is the cash book, and its bank statement also showed a balance of $10,000 as on May 31st. On 25th June, ABC company issued a check for $1,500 to XYZ supplier for the services rendered by them. ABC company immediately records the payment of $1,500 and thus reduces its cash balance to $8,500. Now let us assume XYZ supplier receives the check but does not deposit it in his bank until July 2nd. The bank statement for ABC company issued on June 30th will not show this 1500 deduction because it is not presented to the bank for payment. Therefore, it is not reflected in the bank statement dated 30th June. Hence, there will be a difference of $1,500 between the cash book and the bank statement as on 30th June. Checks deposited into the bank but not cleared is another timing difference scenario which results into the difference in the balance as per cash book and the balance as per bank statement. The statement check deposited into the bank but not cleared refers to a common timing difference that arises between a business account record, that is the cash book, and its bank's record, that is the bank statement. This timing difference is a key reason why bank reconciliation is necessary. When a business receives a check from a customer and deposits it into the bank account, the business immediately records this as an increase in its cash balance in its cash book. However, the bank does not instantly credit the business account with those funds. There is a clearing process that needs to happen. Therefore, in this case, the balance as per cash book is increased immediately, whereas the balance as per bank statement takes couple of days to increase. In this slide, we will learn the process of check clearing. During the clearing process, bank needs to verify the check details to ensure that the check is valid, it is signed correctly and not altered. The bank in which the check is deposited then presents it to the drawee bank, that is the customer bank on which the check is drawn. Once the drawee bank confirms the availability of sufficient funds in the customer account, drawee bank processes the check and transfer the funds to the business bank account. This process takes time, typically a few business days, until the funds are actually transferred and available in the business account. The check is considered as uncleared or an outstanding deposit or the deposit in transit. Let us further understand the impact of checks deposited into bank but not yet cleared. When a check is deposited but not yet cleared, it creates a discrepancy that needs to be reconciled. The business cash book will show an increased cash balance because the deposit has been recorded, while it will not yet reflect in the bank statement as the funds have not been cleared. For example, let's imagine Sunshine Supermarket at the end of May 25 has below status. Sunshine Supermarket's cash book as on 31st May 25 shows a balance of $15,000, while the bank statement of Sunshine Supermarket shows a balance of $12,000. There is a difference of $3,000. Upon investigation, Sunshine Supermarket finds the following. There is a check deposited, but it is not clear till 31st May 25. On 31st May 25, Sunshine Supermarket received a check of $3,000 from a customer, Healthy Foods Inc., and deposited it into their bank on the same day. Sunshine Supermarket immediately recorded this deposit in their cash book. However, because it was deposited late on the last day of the month, the bank had not yet processed and cleared the check by the time the bank statement was issued. Therefore, there was a difference of $3,000 between the cash book and the bank statement of the business. Another reason of difference is the transactions recorded by the bank and not by the account holder. Sometimes transactions are recorded by the bank which are not known to the account holder. The account holder records them in his books of accounts after receiving the information from the bank in the form of a bank statement or a bank passbook. Another reason of difference is interest credited by the bank but not recorded by the account holder. If the bank allows interest to the shareholder, it credits the account holder's account and his balance with the bank would increase, and the same will be reflected in the bank statement. But the account holder will record the entry in the cash book at a later date when it is known to him. Till that time, the balance as per bank statement would be higher than as per the cash book. Another reason of difference is the bank charges and the interest charged by the bank but not recorded in the cash book. Bank renders services to its customers for which it levies service charges called bank charges. Bank also provides overdraft facility for which it charges interest. The bank debits the account holder's account in its books with the amount of bank charges or the interest on the bank overdraft and thus reduces the balance in the account holder's account in its books. The account holder records the bank charges and the overdraft interest entries in the bank column on the credit side of the cash book when bank statement is received. Till that time, the balance as per bank statement would be lower than the balance as per cash book. Interest and dividend directly collected by the bank are some of the transactions which are recorded by the bank and not by the account holder, and there is always a timing gap. Bank bases instructions from the account holder, collects the interest and the dividend on behalf of the account holder and credit them to the account of the account holder. The account holder records the interest income and the dividend in the bank column on the debit side of the cash book when the bank statement is received. Till that time, the balance as per bank statement would be higher than the balance as per cash book. Direct payment by the bank are also the transactions which create the difference between the cash book and the bank statement balance because of the timing difference. Bank may have been given the standing instructions for making regular and periodical payments such as electricity expenses or telephone expenses. When the bank makes such payments on behalf of the account holder, it debits the account of the account holder. The account holder may come to know of these direct payments when the bank statement is received. Till that time, the balance as per bank statement would be lower than the balance as per cash book. Direct deposits in the bank account is another business situation wherein such transactions are recorded in the bank and not in the cash book due to timing differences. If an amount is deposited directly in the bank account, bank will record it in the account holder's account. The account holder will record the deposit at a date when he receives the bank statement. Till that time, the balance as per bank statement will be higher than the balance as per cash book. Dishonor of a bill discounting is another reason of difference in the balance as per cash book and the bank statement. If the bank does not receive payment against the check or the bill discounted by it, it will debit account holder's account along with the charges that it may have incurred. The account holder may know the amount debited when the account statement is received. The account holder will record the entry at a later date. But till the time such an entry is recorded in the cash book, the balance shown by the cash book and the bank statement or the passbook may differ. Bills collected by the bank on behalf of the customer also results into difference in the balance of cash book and the bank statement due to timing difference. If the goods are sold and its documents are sent to the customer through bank, the bank collects the amount and credit it to the account of the account holder. The account holder will record the entry when the bank statement is received. Errors and omission also sometimes results into the difference between the cash book and the bank statement balance. Errors and omissions may be committed by the bank or by the account holder, and these errors result in difference in the balances of the cash book and the bank statement. It is possible that while recording the transactions in the cash book, a check of $100 deposited may be recorded as $1000, as a result of which the balance in the bank column of the cash book will be overstated by $900 and therefore causing a difference between the cash book balance and the bank statement balance. Let us understand the reasons or causes of the difference in the balances of the cash book and bank statement. The first step to prepare bank reconciliation statement is to identify the entries because of which the two balances differ. It may be because some of the entries are recorded in the cash book but not recorded in the bank statement and vice versa. The process of identifying is carried out by comparing the entries in the cash book with those in the bank statement. Therefore, bank reconciliation statement is prepared by adding or deducting the amounts causing the difference. It is prepared either with the cash book balance and reaching the balance as per bank statement, or with the bank statement balance and reaching the balance as per cash book. The entries which causes the difference are added or deducted from the starting balance. Next week on 4th of October 25, in part 2 of our series on BRS, we will move one step deeper into the actual preparation of BRS. We will start by looking at the format of a bank statement and the bank column of the cash book. Then we will understand how the transactions are matched and how we can identify unmatched transactions. We will also discuss two common cases. First, the transactions that appear in the bank statement but not yet in the cash book, and the transactions recorded in the cash book but missing from the bank statement. I will also guide you through illustrations showing the preparation of BRS, starting with the cash book balance and also starting with the bank passbook balance. Finally, we will learn how to present the BRS under both approaches and close with some key points to remember in the reconciliation process. If you enjoy the content of my channel and appreciate my teaching style, please